Okay, so now we have to go in and look at trade cost measurement. So a couple words to help you here. We are now approaching implementation shortfall. Hopefully red lights are blinking and strobe lights and just really getting you to focus on this. Here's the thing. Implementation shortfall is going to be the most heavily tested part of this trade strategy and execution section. You have to crush implementation shortfall. It's coming. Some of these questions are very detailed. You need to practice this. You need to become an implementation shortfall expert. Okay, but what I want you to think about before you get lost in the minutia, I want you to take a step back a little bit. So I graduated from my undergraduate degree in 1993. I know, so I must be getting pretty old. So here's the thought process I want you to think of. When I used to do trades for my own account, maybe I would trade $50,000 and maybe I would pay $100 or $150 in commissions. Today, I could do that same trade for probably $5. And this is what's happening. We're also trained to focus in on explicit cost, commissions, fees, and many people still pick their broker on these explicit costs. But what is so important about implementation shortfall is that it actually registers the true cost that are happening in this trade. So it doesn't just focus on the easily explained explicit cost, it actually brings in the implicit cost. So what are we talking about here? Well, as we talked about in other trading sections, we're talking about market impact and execution risk. I either couldn't make the trade for whatever reason, or when I did make the trade, it impacted the market and the market went against me, hurting my position and actually making it harder for me to earn alpha, to earn that higher extra return. So what I want you to think about, this implementation shortfall is actually going to give you the true cost of trading. As a portfolio manager, this is something that you absolutely have to know. And as you evaluate your trading department and your own trades and look at what happened, you can evaluate where did it hurt you? What happened? Is it execution risk that's hurting you? Is it market impact? It gives you much more information. And again, it focuses on, I believe, the most important part of the trading cost now, which is the implicit cost that are much, much larger on average than this explicit $5 commission charge or whatever it's going to be. Okay, so as you prepare to go through the material and you start getting ready for the exam, please put implementation shortfall at the top of your list for the trading strategy and execution section. You have to know this, no excuses. When you go back and look at past exams, you're going to see all sorts of ways to ask this question. I need you to be familiar with those. We're going to give you a model and a method and some practice that you can do here in the video lecture. There's just not enough time to treat this with the adequate time that it really needs. You need to get out note cards. You need to work a ton of problems. Okay, so hopefully I've emphasized this enough. I didn't have the strobe lights or the flashing signs to show you how critical this is, but this is really critical. Okay, so the total cost of trading, not just explicit cost, but the true total cost of trading can be measured with implementation shortfall. Now, there's another thing that I want to emphasize. Maybe that'll help you understand this a little bit more. So in the previous sections, we talked about VWAP and other indicators that we can use and ways that we can track and measure our trading success. What you're going to find, traders can game these other strategies like VWAP very easily. And they can place trades at times that might be detrimental to your portfolio that makes them look better. Implementation shortfall is extremely difficult to game. So it really places the blame where it should be. If the trader made a mistake, implementation shortfall will show that. If the portfolio manager made a mistake, implementation shortfall will show that. Now, if the trader did well, implementation shortfall will show, and if the portfolio manager did well, we'll also see that in implementation shortfall. So think about it, it's bringing accountability to your actions, and it's absolutely a tool that I would want if I was analyzing my portfolio trades. Okay, so again, I've said this a number of times. I can't emphasize it enough. You have to master this section and implementation shortfall. No excuses. Okay, so how do you do this? Well, the first thing you're going to do is you're going to create a paper hypothetical return, and then you're going to compare that to what you actually got in your portfolio. So this idea of this hypothetical return, this is a paper return. Assume that all of your trade was executed at the original decision price that you saw with zero cost. Again, not realistic. This is as best as it can get. This is this hypothetical. You traded immediately. You got the decision price you wanted. Your full order was filled and you paid nothing. Well, then you're going to compare that to what you actually got in your portfolio. I put in a sell trade for 30,000 shares. You only sold 10,000. Okay, so that's where this is going to be showing up in the actual return. So that spread, that difference between the paper hypothetical return minus the actual return, that is going to be your implementation shortfall. So again, that becomes the total cost of executing the trade. And you'll see after you do a couple practice problems, this is very easy. But what's wonderful about this also, you're likely on the exam to have to decompose implementation shortfall. So it consists of 4 components. There's a delay component, a trading component, there's an opportunity cost component, and then there's that fixed fee or fixed trading cost or the commissions, the explicit cost that we know so well. So let's just say you go through an example, and let's just say the implementation shortfall comes out to be $15,000. Well, we figured that out from running the paper hypothetical return minus the actual return. Well, now the CFA is likely to ask you, okay, well, break it down. Where did this cost come from? So we'll look at the first component and we'll calculate a delay cost. Then we're going to look at the second component. We'll take a look at the trading cost. Then we're going to take a look at the third component, which is this opportunity cost. And then finally, we're going to deal with these fixed fees or these explicit costs that you know so well. So here's the beauty of this. What an easy way to get points on the exam. You know these 4 components have to add up to $15,000. So if it doesn't, you made a mistake somewhere. So it's a great way to go back to check your work to figure out where you made the mistake. And that's what's so great about doing this hypothetical minus the actual return. It calculates the final answer for you. And then in your components, when you decompose this implementation shortfall, you can figure out where you made the mistake. And you should get a perfect score on this because your 4 components should add up exactly to what you calculated. So again, this is a great way to double check your own work also, because you know as well as I do, when you take these exams, it's really easy to make a mistake. Okay, so again, this actual portfolio is the return of the portfolio net of all costs. Okay, and again, the difference is going to be this total cost of executing the trade. So here's the only way you're going to learn this. You've got to work examples. And it's not good enough to hear me work the example. You have to work the example, and you have to work tons of these. And that way you're not surprised. The best way to deal with these, I think, is you have to take a deep breath. Remember, we're going to teach you methods to maximize time management skills. Here's where you're going to have to spend a little bit of extra time. So let's go through this together. A portfolio manager decides to buy, okay? So I always like to underline or highlight, I'm buying. What am I buying? 50,000 shares of some stock SJB at 9 a.m. when the stock price is $20. So what I would put in my notes right here is I would say the decision price is $20. And I submit instructions to the firm trader to go ahead and process this trade. So what did the trader do? They used a limit price of $20.50 and in total manages to get 40,000 out of the 50,000 shares that I originally asked for at an average price of $20.34. So that executed price is $20.34. My decision price was at $20. And I also get charged a commission of 2 cents per share, and there are no other fees. And at the end of the day, the closing price for SJB is $20.55. Okay, so how are you going to approach this problem? What's the easiest way to do this? Well, the first thing that I'm going to recommend that you do, and really you have to do this, you're going to have to calculate that hypothetical change in the portfolio. Let's calculate hypothetically what would have happened if we could have bought all 50,000 shares at the price of $20, and then at the end of the day it goes to $20.55. So the question asks you to calculate in basis points. Don't let this throw you off. It's likely you're going to have to answer the question in basis points. It could be an absolute value. Read the question, take your time. You're not going to have any problems. You're not rushed, so you can go through this. So calculate in basis points the total implementation shortfall for this trade. So let's first do the paper portfolio. This is step one. Okay, what are you going to do? Well, we had a decision price of $20. I was going to buy 50,000 shares. The closing price was $20.55. The decision price was $20. The 50,000 were the number of shares. That day in the hypothetical portfolio, I would have made $27,500. Okay, so that is not the implementation shortfall answer. That is just the hypothetical paper return. I should have made $27,500. Well, what did I really get? Okay, so the actual return of the trade reflects that the trader, remember, they only purchased 40,000 shares of the 50,000 share order at a price of $20.34. So they also paid commissions of 40,000 shares times 2 cents a share, or $800 for that execution. So what did I actually get in my return? I got 40,000 shares. Remember, I didn't buy 50. I only got 40,000. We have a closing price, again, of $20.55. But now our execution price was $20.34. Our commissions were $800. Hey, you know what? I didn't get $27,500. I only got $7,600. Okay, so again, hypothetically, we should have gotten $27,500. In reality, we only got $7,600. So the implementation shortfall is $19,900. Okay, so if you didn't get this, stop the video, go back, rework it again, and keep practicing. Because identifying the implementation shortfall is only half of the question typically. The next part of it, they're going to ask you to decompose which of the four components made up this $19,900. So again, I hope this is making sense. I can't stress how important this is. And again, all we did is looked at a hypothetical, what I could have gotten versus what I actually got. You would do this with your own account. So there's nothing magical. There's nothing difficult about this. This is exactly what you would do if you were managing your own portfolio. Okay, so now let's convert this into basis points because this is what the question asked. Well, first of all, I need to know how much dollars were I actually putting at risk here. So 50,000 shares, $20 decision price, That's $1 million. My cost was $19,900. That was my implementation shortfall. 19,900 over $1 million is 0.0199 or 199 basis points. If you forget, remember that a basis point is just 1/100th of 1%. So that means if you have this decimal 0.0199, go ahead and just multiply that by 10,000, and then that will convert to 199 basis points. Okay, so we had an absolute amount that we were able to calculate, and we can convert it to basis points. It's very troubling to work with candidates and find, they know how to do basis points, but for whatever reason, they thought the question said absolute amount, or they put basis points when they want absolute. These are just easy points. And again, you have to battle for every single point. Every single point on the exam matters. You can fail the exam by 1 point, means you can pass the exam by 1 point. So if you think as you're going through this program, it seems like you're always talking about fighting for that last point. Yeah, that's what we're doing. We're fighting and scrambling and hustling for every last point so you can pass this exam and get your life back. Okay, so let's get into now the interesting part. We figured out that what the implementation shortfall was, but okay, that's great. Well, why? Why did that happen, and what can I do about it? Well, that's where this decomposition comes in. Okay, so again, remember, it's based on that hypothetical analysis, that paper portfolio. And again, usually implementation shortfall is expressed as basis points, but check the question. Again, don't lose easy points. If they want basis points, give them the answer in basis points. Okay, so this reference that we're looking at, we're going to have some initial benchmark or some decision price. So I want you to think, what is the decision price? It is the market price when the trade decision was made. And in most of the examples, when you go back and look, you're going to see it's typically the previous trading close if the market is closed, so the previous day trading. Okay, so let's look at execution costs. Because remember, there were two main impacts that we deal with. They're market impacts and execution cost. So let's look at the execution cost. So this happens, or this occurs when executed shares trade at a less favorable price than that original decision price or DP. We can break execution cost down into two components: delay cost and trading cost. So let's look at delay cost. So this comes from any price movements that happen from when the portfolio manager submits the order to the trader, and then the trader actually places that trade. Okay, so that's what we mean by delay cost. To understand this, we have to be clear on the terminology. Okay, what is the trading cost? This is due to the market impact of executing that trade. That's why we have a whole section on algorithmic trading and ways to actually place trades without having severe market impacts. Okay, then we have an opportunity cost. It's the cost of not trading the full order. Remember the last example, we had 50,000 shares that we had requested to be traded, but only 40,000 of those shares actually were traded. That means there's 10,000 shares that didn't get executed. And unfortunately, the market went up. We had a buy order, so we didn't earn any money on those 10,000 shares. Now, if the market had gone the other way, okay, great, thank God. I'm glad it didn't exercise. But unfortunately, in this case, the market didn't go our way, and that opportunity cost mattered a lot. Okay, so again, I want to bring you back to that paper portfolio just so we're all clear about what it assumes. It assumes all, remember that example, 50,000 shares are executed immediately at what price? At the original decision price. Now, in reality, the actual trade may have only filled part of this order, and lost profit on that part that didn't trade is that opportunity cost. And then the fourth component are these fixed fees or explicit commissions that people are always talking about and seem to spend too much time focusing on. Okay, so let me give you another example. Let's decompose now this implementation shortfall. And guess what? You already know what it's supposed to sum to. Remember those 4 components? We already calculated the implementation shortfall was $19,900. So when we're adding up these 4 components, if they don't total $19,900, we made a mistake. Go back and check your work. There is no reason you cannot get a perfect score on this question. Okay, so let's go through this example. We want to decompose this $19,900. So the trader received the order at 9 a.m. when the stock price was $20. Assume the trader placed the order at 9:30. So look, there's a 30-minute window here before you actually traded it, and the stock market price moved. It's no longer at $20. It moved to $20.10. What is that $20.10? We're going to call it the arrival price, or AP. Okay, so now, knowing what we know, now we can decompose this in dollar terms. And let me show you how to do that. So the first component is the delay cost. Let's take a look. So remember, the market moved from $20 to $20.10 when we were waiting for this to trade. So the 40,000 shares that were actually executed during that day, let's figure out the real cost. So we had 40,000 shares. They were traded at $20.10. My decision price was $20. So that's a $4,000 cost that came from the delay. Okay? That's not $19,900. You're going to have to do all 4 components anyway, but just keeping track. So trading cost. So this is the difference basically between that execution price, the $20.34 that we were filled, and the arrival price when it actually got to the market. So again, we traded 40,000 shares. So we have 40,000 times the price, that execution price of $20.34 minus that arrival price. And what happened? The trading costs were $9,600. So a significant part of that $19,900. Okay, so let's keep going. Let's look at the opportunity cost. Remember, there were 10,000 shares that were not purchased. So what happened here? Well, there's 10,000 shares. The market closed at $20.55. The decision price was $20. So unfortunately, those 10,000 shares not trading, we lost $5,500. Okay, and then finally, our fixed fees, 40,000 shares traded at 2 cents a share commission, $800. Okay, so add it up. We already knew they had to sum to $19,900. There's no reason to get this wrong. Okay, so again, if you didn't get this right, rewind the video, stop, put down, grab a pen, grab your calculator, make sure your batteries are fresh, make sure there's nothing crazy going on with your calculator, and keep practicing this. Once you have the hypothetical minus the actual, you have that implementation shortfall number, the rest of this is just mechanical. So again, no excuses. You will see this on the exam. Okay, so now that we know that we had a $19,900 implementation shortfall, as a portfolio manager, what can I do about it? Meeting with the trading department, what can we do to help this, to implement this, to get this $19,900 lower? So what do we know? Well, remember the first component we looked at were the delay cost. So this is basically the cost due to adverse price movements between when the trader received the PM's order and then executing that trade or passing it to a broker. So how can we minimize this? Remember, it was 30 minutes. when the portfolio manager placed the trade versus when they actually traded. So what can we do? Well, we can actually give the trading team more information. We can give them more resources. We can give them pre-trade and post-trade analysis, and then they can make swift decisions. And maybe next time, maybe they can place that trade in 5 minutes or even less. Okay? Then we can analyze opportunity cost. So we can try to figure out and help this PM figure out a way to use maybe unused cash. Now, one way to do this, if you couldn't buy all 50,000 shares of that stock I wanted, maybe there's another stock that was the next most attractive. Maybe you could have bought those 10,000 shares you didn't buy and used those proceeds to buy the next most important. So if I think only 80% of the order is likely to be filled, or the trader thinks that, well then go ahead and invest the remaining 20% of that order into the next attractive drag. So what are we doing here? We're avoiding the cash drag on uninvested funds. If you haven't looked at a while at a checking account or a savings account, you're not earning much money. In fact, you're almost earning nothing. And some countries you are earning nothing. In fact, less than nothing. It's negative. Okay, so we want to take a look and avoid this cash drag. And using this next most attractive investment, that is a great method to actually help lower opportunity costs. Okay, and then we want to take a look at the market impact. I want to make sure that my trader understood the proper price benchmark we were using and the urgency of the trade, because maybe there was a large market impact and we didn't need it because the trade wasn't that urgent to immediately trade. So again, do you see how this is a training tool for both yourself and your trading team? So that's what's so popular, or I should say so attractive about this implementation shortfall. I wish I had this as a previous portfolio manager when I was a portfolio manager. This would have been extremely helpful. Okay, everybody, so this problem is going to be a little bit tricky, but it's actually a great representation of what you're likely to see on the exam. So when we go through and we prepare for the exam, we're thinking, oh, okay, a buy, this is easy. Well, what are you going to do if you see a sell? Well, let's figure it out now and experience that sense of a little nervousness before you actually have that on the exam. So what happens now in this example? So we've got a portfolio manager. They decide to sell how many? 100,000 shares of Future Recreation FTRB. It's 1:05 p.m. when the portfolio manager decides to do this, and the share price is at $256. So what I do when I look at these problems, because none of us can keep these things straight in our heads, go ahead and label these prices. Okay, so what do we have here? We have a decision price at $256. Now it's in pounds. Don't worry so much about the currencies. This isn't a currency problem. Don't freak out. If I measured your blood pressure real quick, when you saw that currency, it probably shot up a little bit. Don't worry about what currency it's in. Just say 256. Okay, so the trading desk receives the order. They're trying to figure out what's the optimal way to trade this. Now, what they find is that there's low market volume. So what do they decide to do? They're going to use a high-touch agency broker approach. Now, they're putting a limit of 250 on this sell order. Okay, so we know what's happening here. We've labeled the 256 as the decision price, and we have 100,000 shares. Okay, so let's move forward, and we're going to go through the same process. So what happens? Now the trader submits the order to a broker, 113. Remember, it was 1:05, so 8 minutes later. In the previous example, it took 30 minutes, so I say we're getting faster. Now, what happens at this point? Well, now the share price went up to 259. So I want you to set that as your arrival price, your AP. Okay, So again, we're just labeling these. It'll make it so much easier when you're trying to actually decompose this. Now, what happens by the end of the day? The broker executed 70,000 of the 100,000. And what was the average price? So this executed price was $260. Now remember, the decision price was $256. Hey, they sold these at $260. Remember, selling it higher, that's a win. So remember, as you're going through implementation shortfall, it's going to give you more information, and it's going to help you. Not every trader makes a mistake. It's not always a bad thing. Sometimes they can make good things too and do things right. So part of implementation shortfall is assessing both the blame and the credit. So in this problem, we can see right now that we made a decision price basically that was lower than the executed price. So I expect some positive results here. Okay, and what happens at the end of the day? So the closing price is at this 254. Okay, so let's just repeat for a second. What do we have? We have a decision price at 256. We've got an arrival price at 259. We've got an executed price at 260. And then we have a closing price at 254. Okay, so now we have everything that we need to decompose this. So the problem tells us to calculate the total implementation shortfall for the trade in basis points. Let's make sure we get full credit. Remember, nothing hard about converting to basis points. We'll show you again how to do that. Okay, now we're going to decompose this implementation shortfall into 4 components: the delay, the trading, the opportunity, and the fixed fee cost. Now remember, when we calculate this total implementation shortfall, we're going to take a look at the difference between the hypothetical portfolio and the actual return. That'll give us that magic number. And then when we decompose and we sum up those components, they'll add up to that magic number. And if they don't add up to that magic number, well, then guess what? That implementation shortfall, we made a mistake somewhere. And let's double check, first of all, that our implementation shortfall calculation is correct. And if it is, then we made a mistake somewhere in the decomposition. So there should be no reason you don't get full credit for this problem because the numbers have to match. Okay, and remember, because this is a sell order, a little bit different than thinking about it a buy, candidates always tell me sometimes when they take the CFA exam, if they feel like they're almost turning into a pretzel because you have to twist and think about things differently, and that's what we're trying to expose you to in this lecture. Okay, so positive returns are actually earned when the actual trading price is greater than the decision price. So when the executed price is greater than the decision price, well, that's a positive return. That's a benefit that the trader got you. A negative cost is a benefit to you. So we'll dive into this and you'll see what I'm talking about. So just like we do with any implementation portfolio, step 1, what do? Let's calculate the return of this paper portfolio. Well, we wanted to trade 100,000 shares. We traded 100,000 shares. Now remember, the decision price was 256. So let's label this just to make sure you can see this. The decision price is 256. So 254 is the closing price. Okay, so if we take the return of the paper portfolio, we end up with $2,000 return on that paper portfolio. It's a 2,000 pound return in absolute terms. So let's take a look at the actual portfolio. So this is step 2. This is step 1. This is step 2. Step 2, we didn't get to trade the full 100,000 shares. We only traded 70,000. Now we've got some good news. The executed price that we got was actually at 260, and the 254 is that closing price. And again, we also have to take out the $400 that we paid for commissions. And what happened here? the return on our actual portfolio, it wasn't 2,000 pounds, it was 3,800 pounds. So let's put a big smiley face. This is great. So our implementation shortfall actually is negative. Remember, you take the paper return minus the actual return. 2,000 minus 3,800 is negative 1,800. And again, we expected that because we saw the market was going up as the traders were placing the trade. Okay, so the paper portfolio, let's look at the cost. Let's convert this to basis points because that's what the question asked for. So we needed 256,000 pounds. So a negative 1,800 over 256,000 is negative 0.00703. How do you convert this? Just multiply it by 10,000. And what do we get? We get a negative 70.3 implementation shortfall. And again, we expected this because that execution price, the trader sold it higher than the decision price. So we should have already expected this, and we get the negative implementation shortfall. You shouldn't be surprised. Okay, so what does this mean? Remember, a negative cost is a benefit. This means that the trader's actions actually added value relative to this paper portfolio. Okay, if the trader had immediately executed the sell order with no trading costs, the portfolio would have been worse off than the actual portfolio. Why? Because the prices rose and those executions were made at a higher price. So again, don't let selling confuse you. You know it's better to sell at a higher price than a lower price. Okay, and again, this negative implementation shortfall, it just means that the trader actually benefited the portfolio. Hey, the trader might not benefit the portfolio next time, but we got to give him credit. They did a great job here. Okay, so again, we've got to cover all four of the cost. We covered we're going to now dive into the delay cost. That's what they're asking for. They want to break down this implementation shortfall. The first component is the delay cost. So the number of shares traded, which were 70,000. Okay, the 256, remember that was the decision price. The 259, remember that was the arrival price. Okay, so what happened here? A negative $2,100, actually 2,100 pound cost. And again, we want to convert this to basis points. So take that negative 2,100, divide it by 256,000. We get a negative 82 basis point delay cost. Okay, so hopefully that makes sense. If you didn't label these, there's no way you can remember all these things under stress during an exam. Okay, and again, exactly what we expected, a negative delay cost represents value added. The price movement during the time the trading desk received the order and submitted it, it worked in our favor. It doesn't always do that, but this time it did. Okay, so now we want to take a look at the trading cost, which is the next component in the implementation shortfall decomposition. So again, number of shares, 70,000. What do we know? The 259 was the arrival price. The 260 was actually our executed price. Remember, we got a better fill. So what happened trading costs? Hey, negative again. I love negative costs. So 700 pounds negative, again, convert it to basis points. What do we have here? Negative 27.3 basis points. So again, this becomes very easy once you properly label and you know the formulas. You know, you just practice, it becomes repetition. You don't even think about it. You almost become an implementation shortfall machine. Oh, it turns out computers can actually do this too. Just letting you know. Okay, so again, this negative trading cost indicates that the actual execution price improved on the arrival price of the order. Okay, so now the third component, let's take a look at the opportunity cost. Remember, we wanted 100,000 shares traded. We only got 30,000. So that 30,000, let's figure out what happened. So the 256 was the decision price. The 254 was the closing price. So this was an actual cost. This isn't negative, this is positive. The opportunity cost was 23.4 basis points. Okay, then we look at the fourth and final component, the fixed fees. They told us it was $400. So 400 over 256,000, 15.6 basis points. So we knew that this was going to total negative 70.3 because we already calculated that from our hypothetical portfolio minus our actual returns. So again, if your answer doesn't add up to negative 70.3, you made a mistake somewhere in your decomposition. So we subtract 82 basis points, 27.3 basis points, then we add 23.4 and 15.6, we get negative 70.3 basis points. So again, I don't want you to stress about this. You've seen a buy, you've seen a sell. There's only so many ways they can present this material. The more you practice, you will get this, but you're going to have to play around. And what I did as a candidate, make up your own problems. Play around with the arrival price and the decision price and your executed price and your closing price. You know, play around with those numbers, and then intuitively it should make sense. So good luck, keep working, you can do this. I did it, many people can do this, you can do this. And remember, I do not want you to leave the trading section until you can master implementation shortfall. And on implementation shortfall, I would actually recommend work as many problems as you can, look at past exams, go to the CFA Institute source material, the Kaplan material, anything you can get your hands on is going to help you on this section. So good luck, you can do it.